Hey guys, welcome back to another video. Today we are going to be looking at weed stocks. And by the way, if there's a stock that you guys would like me to cover in my next video, just shoot a comment down below and I'll see what I can do. And so, alright guys, we'll get to it. And so the weed industry, it's very young. Regulated weed hasn't been around for very long, and so there's a lot of untapped potential in this market. The US legal cannabis market is expected to grow at a compounded annual growth rate of 26%, which is a lot. This means there's a lot of opportunities to capture that growing piece of the pie in the industry, especially if a company can execute on its business strategies. So there are two companies that we're going to be covering today. It's HITI and Tilray, and so we'll be going heavy on the numbers today. We'll have a look at those statements, interpret some numbers, and then we'll go through share price and revenue projections at the end. First up, we have HITI, ticker HITI. So there wasn't much going on up until 2019 with this company. They were likely preparing like all the others with the up and coming weed boom at the time. And it actually looks like they were struggling in their early stages, especially in 2018 when their revenues took a hit. Expenses nearly double it looks like, and this resulted in quite a large loss. But then you can see an explosion of growth in 2019. The company reported 268% revenue growth in that year, followed by 166% growth in 2020. And while their costs increased significantly, 353% in 2019, they managed to improve in their operational efficiency and level it off the year after, which is a good sign. This means the company is aware that things were getting out of control and did something about it. And so three very important line items that I pay attention to, especially when I analyze stocks in the weed industry, are gross margins, cost of goods sold, and operating expenses. Now, while revenue growth and revenue are quite important, placing too large a focus on just that number can be bad because almost all these companies in the cannabis space are not profitable, and we'll need to see if the path to profitability is really going to be there, and how these numbers move is going to be the answer. And so because the industry is in such a competitive state and weed isn't a very differentiated product, these companies are going to be price takers for the most part and compete mainly on who can provide their customers with the cheapest weed. So you're going to see that years down the line, if a company cannot keep their costs under control, they will be in trouble. And when we look at gross margins, you can see the contraction that happens here as the legal market really started to open up and competitors in the space took notice of the opportunity. So 36.2% in 2019 and 37% in 2020. We'll note this and keep track as we'll look at Tilray right after. And onto operating expenses, these numbers are important because the cost of growing and producing for these companies are going to be somewhat similar as well, and it'll be up to the companies to innovate and improve on their production processes to find cost advantages to be able to better compete on pricing. So operating expenses as a percentage of revenue, the company makes was 99.5% in 2019 and 36.5% in 2020, so a huge improvement. And one last thing that I'll note here is that cost of goods sold ballooned to 294% and 172% in the last 2 years. This increase in COGS, we call it, follows in the way of revenue and usually happens when there's been some sort of expansion, and we know that HITI made a number of acquisitions during this period, so it will be important to see how it moves in the future, especially with the company growing as fast as they are. Next up, we have Tilray, and these numbers are post-merger with Aphria, so everything we look at will be in the combination of the two. You can see the $542 million in revenue, which is the most for any company in the industry. So in 2015 to 16, you see that spike and the two companies grow pretty substantially over the years. And again here, you see the contraction in gross margins in 2018, like we saw with HITI. In terms of expenses, it looks like 2018 was a bad year overall for the two companies. Their expenses ballooned 443%. They went from being positive on earnings before tax the year before to reporting a loss of $22.6 million. But with both companies aiming for growth and expansion, the losses they're posting really doesn't look bad at all compared to ACB and Canopy Growth Corp. I think if you were to tell me Aphria and Tilray they were going to merge in 2019, they would have easily been the best company you could have invested in. And now that it's actually happened, I think Tilray looks like a solid play based on what we've seen so far. So I'm going to point out a few things that investors should want to see improvements on. These margins for sure, I'd like them to aim for that 40% mark, especially in the future. At 31.8 and 35.2, this is a lot lower than high tide. And so this does give me some confidence in high tide. And this interest expense over here, they must have taken on a lot more debt. And this is really going to eat into the company's profitability. If you look, 34.4 and 84.6, almost 41% of their loss was due to them paying off loans. I think if they can show any sort of sustained performance and growth in the next couple of years and incrementally improve on the two things that I talked about, I think they will be the company that everyone needs to be scared of. In terms of on the macro competitive scale, the only challenge that I see with this merged company is that Tilray doesn't have a foothold in the US, and Afria's acquisition of Sweetwater Brewing isn't the worst, but also not the best channel to leverage in terms of just allowing them to scale as quickly as they'd like, especially with operations and distribution. But with high tide aside, this company right now is just way healthier than ACB and Canopy, and I can't imagine why you choose those two over Tilray, unless maybe if you think they can dig themselves out of that giant hole that they're both in right now. On the balance sheet of High Tide, it looks like they were well capitalized, ending off 2020 with 7.52 million in cash, and they also recently announced an even larger upsized financing deal for 23 million, so the company is going to have a lot more money to work with here. Their receivables are also trending at a much better pace compared to years back. When you see cash to receivable ratio go a little too high, it's a signal that customers or suppliers may be having trouble meeting with their payments, but that's no longer an issue. So property, plant, and equipment, PPE I'll refer to from now on, increased a lot in 2019 and 20. This is pretty in line with their revenue growth during those years, as they really scaled up production and sales during that period. I'm also seeing some improvements to the company's balance sheets over the years. If you were invested into this company back in 2016 and 17, you would have been pretty worried because the company by the numbers did not look healthy at all. Their current assets to current liabilities during that time was 0.48, which is way below that target ratio of 1 that you'd like to see for any sort of security that the company wouldn't go bankrupt at a moment's notice. So it went above 1 in 2019, but last year we see this number dip below 1 again, which I'm guessing was due to heavy pressure from the pandemic. Recently, the company paid off a lot of their debt by converting 20 of the 27 million that it owed back into equity. And I know dilution has been a topic brought up a lot by the high tide investing community. And I think what I'll say to this is that it looks like it was necessary because they owed a lot of current debt, which meant they had to pay it off within the year ending 2020, and they did not have a lot of capital to do so. Which, even if they did, it would have definitely hurt the growth prospects of their company. And so I think it was perhaps a trade off that was needed. So all this really means that we are going to need to see some good growth from High Tide to see if they're really providing value to shareholders moving forward. If they can continue to execute successfully, then this dilution won't mean much in the long run. Okay, so Tilray, cash liquidity of 497 million to end off 2020. You get a current liquidity ratio of 2.92, so this checks out. It doesn't seem like the company will be running into too many cash problems in the short term. It does look like everything on the asset side checks out okay. Receivables trending normally as you'd expect. PPE as well. Their total assets have been growing each year, even squeezing out that small gain in the pandemic year. On the debt side, there's a large spike in liabilities from 2016 onward, but this levels off in 2020. The amount that they're borrowing also went up dramatically, but this was probably to help them with things that they needed to grow. One thing that I'll know in the equity section is that the companies diluted a 10 back in 2018 and 2019, which also levels off somewhat in the last year. I went back and had a look at what happened there, and it looks like Afri had a ton of bought deals raising money wherever they could. And I mean, when I look at the amount of cash that they don't have nearly as much as Canopy growth. They have 1.6 billion in liquidity, but they're posting much larger losses than Tilray. So I think I'd still go with Tilray, especially since they're trading at a lower valuation and are finding that revenue growth that they need. Okay guys, we are on to the good stuff, and if this is the only reason you came to see this video, come on guys, like this video and subscribe to my channel. It will really help me out here. And so what I'll say, like I do with all my projections, the further out they go, the less accurate they'll be. And with this model, I won't say that they're the most conservative, but definitely not the most optimistic either. So High Tide did 38 million in revenue in Q1, And in the company's latest earnings call, they projected a annualized revenue run rate of 148 million. So we got that there. They noted gross margins of 38%, so we'll follow that exactly. I have them growing at 40% flat until 2024 and then tapering after 2025. I think this should follow industry trends. The next 5 years are going to be full of growth, then start to cool down as the market shows signs of entering that phase of maturity. Cost of goods sold here, you can see the percentage up there. That's the gross margin I have calculated and projected. I have it improving slightly over time, but capped up at that 43% level to keep our projections steady here. G&A expenses, we're not likely to see a drop like we did in 2019 to 20. In fact, I think it'll go up in the next year or two, then stay relatively even. Depreciation should increase as they scale up, so I have that growing just a little bit and then leveling off at 15%. And down here, I have some more expenses, but they really aren't too relevant. You can pause the video and give them a read, but really nothing important here. And so here are the share price projections. Have a look at the blue lines, 15 to 25 times multiples. You can see in 2022, the price of the stock ranges from that $8 to $14 range, which is pretty in line with what analysts expect. 13.5, I believe. And so years out, you can see that the stock price moves from the teens to the 20s, and in a range that looks pretty attractive further out. But what I would suggest though, when you're looking out more into the later years, focus on the lower multiples, because these companies won't be growing nearly as fast as they would have then, and we don't know how investors will be valuing these companies further out as well. And next up, we have a projection of Tilray. This one was a lot harder to project compared to HITI. There are a lot more moving parts going around, and so I tried to be a little more conservative on this one. The company announced a pro forma revenue of $685 million during the time of the merger, and so I have that here. Analysts project 2022 to a range of $890 to somewhere in the $900 million. And in terms of margins, the company did 30 to 35.21 in 2020, and I projected it to increase in scale as well, as the company is going to realize some synergies in the merger later on. But I could very well be wrong, I feel like, and it could go down in the short term actually. They are essentially two companies moving together at once, so I'm not sure how things will look in the short term, but I know further down they should improve more. And so that's operating expenses. Next we have G&A. I increased it more in the first year to account for the merger and then leveled it off after. Depreciation over here shouldn't really change too much, but we should expect a small increase. Stock-based compensation, I kept that a steady 5%, and for everything else, you can just take your time to read what I have in the notes. Some of these numbers are larger, but I tried my best to use assumptions going forward. And so here we have share price projections. Instead of looking at EBIT, we'll use revenue multiples instead. This is because a company isn't expected to make a profit a while longer than HITI, it looks like. So I've highlighted in the light green box down here in 2022, share price estimates range from $21 to $26, which is pretty in line with what the analysts that cover this stock think. Moving forward, you see the stock move to the 20s, 30s, 40s, and all the way up to a price target of $92.53. And I'll take this information however you'd like, but I'll throw some salt in there because this wasn't the easiest for me to project, but I'm glad I got to share it with you. So if you're looking to invest in the weed industry, I feel like these are two decent plays that could potentially provide a lot of upside in the future. And so that's it for this video. Thank you for listening and happy investing, guys. Good luck.